Hello, our friends. My name is Mary, and today we will be discussing the CVD tool, the application of divergence in modeling, a popular long-short pattern divergence trading strategy, and most importantly, our development. Let's start with the basics. The CVD cumulative volume delta indicator is a technical tool used for analyzing trade. It helps to understand the balance of buying and selling, showing the difference between the volume of buy trades and the volume of sell trades. Generally, it's a fairly primitive tool that aggregates, meaning it adds up the volume delta over a period. Now, let's examine divergence and Convergence. Divergence is a mathematical operation applied to vector fields. In trading, divergence is a discrepancy and convergence is a compression. If you have worked with statistical arbitrage pair trading, then it makes sense to view this phenomenon as a spread, whose occurrence is due to deviations of the two instruments from each other. A spread can also arise when our instrument deviates relative to another. However, divergence is the fact of both instruments deviating. Convergence essentially has a similar principle. There is A and B. In our case, A is the price and B is the CVD. They are deviating from each other, then it's divergence. If A and B are moving towards each other, it's convergence. So if we transfer B, we find that it's the same divergence, or if you like, a spread. The main idea is to buy the spread or divergence of the CVD and the price. It's quite simple and logical. We want to buy or bet on the imbalance that has arisen in the market. Now to the main strategies. Accumulation of positions by large participants. Large market participants often act discreetly. When they start accumulating or distributing positions, this may not be immediately reflected in the price, but it will be noticeable in the change in volumes which the CVD captures. If the price rises, but the CVD falls, this may indicate that large players are selling despite the price increase, potentially signaling an upcoming downturn. Second, trend exhaustion. An uptrend is supported by an increase in buying volume. When the price continues to rise but buying volumes start to decline, reflected in a falling CVD, this may indicate that interest in buying is waning. Without volume support, the current trend may be unstable and prone to reversal. Third, divergence of supply and demand. If the price rises without volume support, this may indicate an artificial or temporary nature of the movement, which usually leads to a correction or reversal. Popular strategies that offer trading of the CVD and price spread often look primitive. We won't dwell on these strategies for long, especially we won't be looking at any hidden or weak signals. But we will conduct research into the influence of divergence and convergence on subsequent price changes. Our methods for identifying divergence and convergence is built on the foundation of a model similar in principles to regression. We fix significant divergences and convergences within the day, filtering out all weak ones. Now we will conduct short trades on divergences and long trades on convergences, adhering to the fundamental logic. We will close trades when the model considers the divergence potential exhausted. Taking 50 random assets and testing them, the results showed that intraday divergence trading has significance. However, when trying to trade convergence, the results were chaotic. Thus, divergence of the CVD and price can be used as a predictor of the potential development of the price trend in the cryptocurrency futures market. So the logic of convergence trading is actually confirmed by our research in the intraday context. This is a classic type of mean reversion, and diverse effective strategies can be built on this logic.
in the long-short context, divergence as a trading logic completely loses its significance, and considering it as mean reversion definitely doesn't make any sense. It's not really a predictor for momentum strategies either, as it loses its relevance, evident in the type of P&L, profit and loss formation. However, convergence continues to show positive results on a larger scale.
Now we have the second part of our research where we will touch on spot CVD analysis and conduct comparative tests. I hope this will be interesting. We have built our own tool for evaluating significant delta, and it tears apart everything that is presented on the market for assessing imbalances. This tool will be focus of our next material. Thank you for your attention. If you have any questions about the test, please feel free to ask. We are open. See you soon!